sustainability still is, sort of the overriding, the big picture. ESG is the tool that helps you assess your progress against that big picture. The outcome that I think we're all after is to have our businesses operate in a sustainable way. And when we measure that outcome, or when we talk about our performance, we can use ESG criteria. Thus, the good news for all of you is that you're not going to have to change your job titles from Sustainability X to ESG X. I think you're all still going to be sustainability people, and you're going to be using the ESG tools as you do your work. But that's not to say that ESG doesn't matter. Not surprisingly, one of the big consulting companies, McKinsey, recently released a report titled, "Does ESG Really Matter and Why?" And they concluded that ESG does matter. But when you dig deeper into the report, they base their conclusions on the conviction that sustainability continues to matter. For years, we've been talking about all the reasons that sustainability matters, and Lori talked about those again this morning in a very, I thought, crystallized way. And those all continue to exist. What's changed, at least a little, is investors' interest in a company's sustainability performance. That's an important change, but it doesn't undo the years of work on why sustainability matters. ESG is also different in that investor demands go directly to the C-suite. That may seem like a good thing. After all, it's investors who influence the board, who in turn influences the C-suite. But this also bounces up against the sustainability efforts that are being driven from within the organization. So organizational sustainability people may feel that ESG is a narrow agenda focusing primarily on climate change or whatever the new issue of the day for investors is, and it minimizes the broad, important work that you all have been doing for years. That work continues to be important to shape the day-to-day work that's done in your businesses. That growing interest in ESG has at its heart a belief, which I hope we all feel, that business can play an important role in addressing societal and environmental challenges. I find it interesting that there is a group of Republican elected officials that seek to ban their pension managers from using ESG criteria in selecting investments for pension funds. There are governors and state attorney generals that oppose the use of ESG criteria, and one would assume that apparently they believe that despite ample evidence and scientific consensus to the contrary, that poor working conditions, unfair compensation, waste and inefficiency, and even poor governance practices don't represent a material threat to the company. Because if you're going to take the position that we shouldn't be using ESG criteria, you have to accept the position that all of the things that those criteria are evaluating aren't relevant to the business discussion. And I would guess there's probably no one here that would argue that those criteria aren't relevant to the success of businesses. For really good reasons, our investment hypothesis is still that businesses that translate sustainability into revenue growth opportunities, cost reduction, and risk reduction will outperform companies that ignore sustainability opportunities. So let me introduce this panel because they're great. This is going to be a fabulous session, and I think you're all going to be able to go back to management and say, this is why we came to this event. Hillary Vedvig spoke last year on the growing importance of ESG, and we wanted to invite her back again this year. She's a lawyer with Foley and Lardner, and a graduate of the Yale Law School. While in school, she worked in Kosovo for the European Human Rights Advocacy Center. At Foley, Hillary works in the environmental law area, which also includes sustainability. She assists clients with sustainability reporting and works on a variety of ESG issues. And she says she's always going to be a Packers fan at heart. Now, that's going to be relevant as I introduce Johan. So the second speaker will be Johan Luneba. He's joining us from Finland. He is the Vice President of Sustainability and Public Affairs at Almstrom. His broad experience in sustainability from various industries, such as paper and pulp, renewable energy, mining, and materials. And with Almstrom's strong presence in Wisconsin, he writes, his quite frequent visits over here, he started to turn into a cheesehead. And he will experience his first Packer game tomorrow. And then finally, see, look at that. We like our Packers. Finally, Cindy Bolin is the Chief Mindfulness Officer at Riverwater Partners. Prior to joining Riverwater, she managed money for clients at Robert W. Baird and M&I Investment and Management. With Riverwater Partners, she works on ESG and sustainability information gathering and reporting with companies that her firm is considering investing in. She's also the board chair for the 7th Generation Interfaith Coalition for Responsible Investment. She lives in Milwaukee, and amazingly, she also is a Packer fan. So Hillary, I'm going to turn it over to you to begin with. I think there's mics. There's 2 mics, one on each side. We'll do Hillary, and then Johan, and then finish with Cindy.
Okay, great. This is on? Yes? Okay, excellent. I recently started teaching at UW-Madison, following in Tom's footsteps, apparently, so I'm going to make sure my voice carries in this very large, echoey room. Hopefully everyone can hear us today. Thank you, Tom, for that great introduction of where we kind of are in terms of overlap between sustainability and ESG. I'm going to talk a little bit about the legal aspect of ESG this morning. Last year when I spoke at this conference, I was talking about what a few agencies were planning on doing, and today I can tell you what they've actually done in the last year. So first I'm going to talk a little bit about the Federal Securities and Exchange Commission, some movement there on ESG reporting, and then I'm going to talk a little bit more about the state laws that Tom touched on that are making movements towards, quote, anti-ESG legislation. And then I'm going to talk a little, just very briefly, about COP27, which is happening right now in Egypt. So the SEC, the Securities and Exchange Commission, last year I talked about how they were signaling that they would be passing rules requiring public filing companies to report on certain climate emissions data. They have since proposed those rules. It was been in the news a lot, but I'm a little biased in what news I read, so I'm going to go over kind of the basics of the rule that they did propose. It contemplates that public companies that file with the SEC must disclose certain information relating to their emissions. It covers 7 different greenhouse gases that have to be reported both aggregated and disaggregated. There are 3 scopes that have to be reported. So the first scope are the direct emissions from that company, so exactly what that company emits. It's relatively easy to understand if you can put the processes in place, and it's all in the control of the company. So that's scope 1. Scope 2 are the emissions that result from the power that a company uses, essentially. So the electricity or other ways that a company is powered. What are the emissions from those energy sources that the company is using? Again, relatively should be easy to understand, easy to capture that data. It's in the company's control in the sense that it is purchasing these emissions or purchasing this power that is resulting in emissions. That's scope 2. Scope 3 is the big controversy and is why everyone here, whether you work for a public company or not, should be paying attention to this rule because Scope 3 is everything else that a company has an impact on. So up and down the supply chain, any emissions that result from, for example, the customer's use of the product that you make, any emissions that result from any party in your supply chain, those are all captured in Scope 3. So it's everything else. Those are not in the control directly of the company itself, but they are responsible for that emissions chain, so to speak, because they are participating in that system that is resulting in those emissions. So not every filer is required to report on the Scope 3. I won't get into the details, but it's large filers. There's a phase-in period for having to report these, but it means that even if you are not a large filer, if you are in the supply chain of a company that is filing, you might be asked to give that data to them. You might be asked to be accountable for any of your emissions relating to that filer, and so you have to be able to provide that data because they're going to be asking you for it. So it's a very large rippling effect. People are very both excited about it because it means that companies will actually be responsible for all of the emissions that they are responsible for. And it also is scaring a lot of people because it's going to be difficult to get that information. It's going to be difficult to verify that information. And it's seen as a very large burden for certain filers. But that's what the rule contemplates, that companies are going to have to all report on Scope 1 and Scope 2, and Scope 3 is going to be for certain large filers and other types of filers. There are also requirements relating to attestation. There's certain liability that attaches to the information that's provided in these reports, so you are subject to enforcement if you lie or if you are not verifying the data in an appropriate way per the SEC rules. I won't get into those details, but there is real liability attached to this reporting. So this rule, the proposed rule, was released in March. It was 510 pages long, so there's a lot more I could talk about, but that's kind of the really, really high level, big picture. It received public comments through June. There were over 1,000 comments received. I read not all of them, many of them. There were a lot of people who were very against the rule, who said that it was interfering with the purpose of business, which is to maximize profits. This was going to be a huge burden on companies that is not related, again, kind of what Tom said, materially to the purpose of that business. We had a lot of people who were saying that certain types of industries should be exempt, such as customer service industries, or, for example, a law firm, which doesn't, it's not a manufacturing facility, it's not an oil and gas company. But the whole point of this rule is that everyone is going to be accountable for their emissions, and that is going to give investors, because again, we're talking about the SEC, this is broad reaching, but this is supposed to be for investors. They are focusing on things that are material to the return of a company. And like Tom said, I think everyone here would agree that emissions data is relevant and material, or should be, for most filers. I won't get into my opinions on this. I'll keep moving forward. So the comments were received in June. We were expecting the agency to publish the final rule, which could be exactly the same as the proposed rule. It could be significantly different than the proposed rule. They could scrap it altogether. But apparently there was some error in the way comments were submitted, and not all comments went through. So in October, they reopened the commenting period for anyone who tried to submit a comment and it didn't go through, so that delayed everything. So the second commenting period is now ended, but we haven't seen a final rule. We still are getting signals from the agency that they expect to publish the final rule before the end of 22, which is very rapidly approaching, so we'll see if they do, but that will be very broad-reaching, and it's something that a lot of companies are currently anticipating, getting consultants lined up to capture this data, and also gearing up to sue the agency. A lot of organizations are very angry about this proposed rule, and we are fully expecting there to be lawsuits over the rule. In fact, I gave a talk on this proposed rule a couple months ago, and someone came up to me afterwards and said, hey, we're gearing up to sue the SEC. Can I talk to you about this rule? So there will be litigation following the publication of this rule, but we'll see exactly how it comes out, if it looks exactly the same as the proposed rule or significantly different. Make sure I'm on time. Okay. So that kind of covers one of the big movements on ESG at a federal level. At the state level, as Tom mentioned briefly, there are a number of states that are passing what are being considered anti-ESG laws, which mean that these states are passing laws that are prohibiting either state government or municipalities or some kind of organization in their control from investing with financial institutions that have, the different laws are written in different ways, but essentially any kind of ESG platform or a certain kind of ESG platform. For example, in Texas, it prohibits municipalities from investing with financial institutions that have any kind of investment philosophy that prohibits investment in fossil fuel. It's kind of like a double negative, so it's a little confusing. But if an investment company has any kind of fund that does not purposely excludes fossil fuel or promotes only clean energy, then the state is saying that the municipality cannot engage with that financial institution, which, as you can imagine, that's a lot of financial institutions these days, and it's the big ones that have better rates. So the state is coming up with a list, and they've come up with one list so far, of financial institutions that they're banning, that they say have these kind of philosophies of ESG investing, and therefore the municipalities are banned from investing with those institutions. Other states are passing similar laws related to boycotting industries like the firearm industry, boycotting things related to agriculture, more oil and gas like fracking. So the states are essentially scrambling a bit to protect those industries that are really important as they see it to the economies of their states. But at the same time, it's hurting their states and their municipalities and other government institutions from investing with companies that have good returns, because you're preventing them from engaging with the large banks who are making these commitments to open up and expand ESG funds. So we will see where that goes. More and more states all the time are passing these laws. The recent election is probably going to accelerate some of these laws as the Republican Party has kind of spearheaded these efforts. So I won't list off all the states, but there are 13 states that currently have these laws passed and many more that are considering the passage of these laws. There are other states that are doing the exact opposite. So they are saying that you have to have some kind of ESG philosophy in your investment fund in order for the state or municipality or county or whatever kind of government entity to invest with you. So California has some laws like this. The city of Chicago recently announced that it's going to divest from all fossil fuel funds over a course of years. So there's a lot of competing and conflicting interests here at the state level, which is of course very difficult for large financial institutions that borrow across all states. But it's an interesting landscape to be sure. Okay, I'm coming up on my allotted time, so I just wanted to briefly talk about COP27, which is essentially the World Conference on Climate Change that is currently happening in Egypt, and the leadership that President Joe Biden is presenting on behalf of the American people, saying that the infrastructure bill that was recently passed is a sign that the US is taking a big leadership role again in climate change after it stepped back from the Paris Agreement and did other things under the previous presidency that were seen as not moving forward on sustainability worldwide. And so the president is really focusing attention on what the US is doing in terms of the infrastructure bill. I won't get into the details of that bill, but as you are all aware, I'm very sure it has a lot of funds and money and direction for more sustainable development across the country. So that is something that we are watching very closely to see how COP27 shakes out. I'm sure a lot of you are here as well. But with that, I will pass it over. I think, Johanna, are you next? Okay, great. And we look forward to answering questions at the next panel, but thank you so much.
Very good. So my name is Johan Lunab, and I'm representing Ahlström, and will not do a company presentation here, but we are a specialty paper company, and we are a global operator, but we have a strong foothold here in Wisconsin. We have 4 big paper mills here, and that's also one of the reasons why I'm here. And I think to bridge a little bit from what Hillary started, so I think my contribution here could be to elaborate a little bit more and explain how the European Union regulation works on this ESG topic. So you know that the European Union was originally founded for economic integration. So we had a bunch of countries in Europe after the World War that were fighting each other, and the idea was that by integrating them economically, that would bring prosperity and peace for that part of the world. And of course, the EU has developed quite significantly, and I would say that at least since the last 20 years, the primary objective of the European Union and the policy making and the regulation has been to enable and promote sustainable development. So that's the primary objective of EU today. And there are definitely many similarities between the US policy and regulatory landscape and the EU. And I think maybe some of the differences is that in EU today, the regulation around ESG, it's far from voluntary, so it's mandatory, and it's I would say it's highly detailed, and it's centralized and very top-down driven, whereas in the US it's maybe less stringent, based on voluntary participation. And I would say those would be like the key differences in how we approach regulation around sustainability. But I think the modern EU and how the policy making is taken forward and how the regulation looks like, it's very much about continuing to drive the EU strategy on sustainable development. And there are a couple of key pieces of regulation and key pieces of guidance that are like shaping the marketplace in EU today. And I think the umbrella piece of regulation is something that we call EU Green Deal. And it's the commitment of the European Union for climate neutrality, first of all, but then the second element is about decoupling economic growth from the use of natural resources. And this piece of regulation is a package of different directives. It really guides all the economic activity in the European Union today. So we have the EU Green Deal, which is the umbrella, and then we have lots of different regulatory bits and pieces here and there that are impacting how we do business in Europe. So we have something that we call Fit for 55. This is the short-term climate goal of EU, and Fit for 55 means that the European Union countries need to reduce their greenhouse gas emissions with 55% from the baseline year until 2030. And then we have a directive for circular economy, meaning that we need to move from a linear economy where we produce, use, and dispose to a circular economy, where we make sure that we capture the value of the raw materials and keep the value of the materials in circulations for as long as possible. So that's a big regulatory piece in the European Union. And then you talked a little bit about the implications on the financial side of things. So quite recently, last year, there was this taxonomy regulation that was put out in EU, and taxonomy in EU means that it's clearly defined what is sustainable economic activity in EU. And I think the implications of this document or this regulation is that when you do financial activities in the European Union region, you really need to follow this taxonomy. So it's about promoting sustainable investments. And I think how this could impact also EU is that these financial markets, they are global markets. So if you are if one of your investors would be a European Union-based financial institution, they would also likely to be asking you that, are you compliant with this EU taxonomy? So then you need to disclose to this institution that how your activities are sustainable or not. And there's mandatory reporting also around this. So there will be also this kind of implication from this kind of regulation. And I think Tom asked us that again a little bit, what's the similarities and differences. So I think in Europe in general we are quite open also to this kind of taxation and fees and penalties for behavior that is not sustainable. I think that's one of the major differences between, I would say, EU and US overall. And I think the development in Europe, and especially the business side, is that we are a little bit turning away from this maximizing the shareholder value towards maximizing the stakeholder value, and contemplating a little bit that how can we ensure that the shareholders get their short-term benefits, but how do we maximize and enable long-term growth and long-term prosperity through this stakeholder value approach. So I think those would be like the key elements in the European Union regulation, as well a little bit as the similarities and differences in the regulatory landscape. And I think maybe the key message here is that I think in both of our regions, what we see in terms of the changes in the regulatory landscape, this is just the beginning. So there's definitely more to come. In European Union, the next wave will very much be about accelerating the circular economy and also improving the biodiversity aspect of sustainability. And it will very much limit also what kind of resources and raw materials we can, for instance, use in our production. So those would be the key elements entering the EU regulatory landscape. But again, the key issue there is that I mean, this is just the start. Definitely more to come. and it will definitely impact the business landscape in both EU and US.
Riverwater Partners, which is a Milwaukee-based registered investment advisor devoted to sustainable investing. I'm a member of our equity research team, and I lead our sustainability efforts with publicly traded small cap companies. As fiduciaries and in alignment with our mission, which is to make the world a better place by growing wealth through sustainable investing, we seek both better outcomes for the planet and its people and better returns for our clients. And this idea that we're sort of reimagining business purpose from simply generating profits is kind of interesting to me, because the actual purpose of any business is to solve a problem for society. And importantly, for a business to endure or be sustainable, it must also generate profits over time. The good news is that these are not mutually exclusive concepts. In fact, there's growing evidence that a focus on sustainability offers companies lower risk, new opportunities, hence higher profits through higher revenues and lower costs, and stock price outperformance for public companies. And let me just share with you a few examples. It's really intuitive, I think, but if you can lower your energy or water consumption as a company, chances are pretty good your costs are going to go down. We invest in a small manufacturing company called Adcor, and their Belgian employees last year participated in the Flemish government's Warm Sweater Day initiative, choosing to lower their thermostats by 1 degree Celsius, which saved approximately 6% of energy use and reduced carbon dioxide emissions. So in 2022, that would be a much bigger savings. And imagine what you could do over a year. Another example is strong corporate culture. Strong corporate culture leads to better hiring and retention of employees and productivity. Starbucks is known to be one of the QSR brands with a relatively low turnover rate. At only 65%, this coffee house definitely stands out from other brands that often have turnover rates of more than 100%. How? Because they've been paying their workers $15 an hour for years, long before it was mandated. They have an extensive benefits package, and they call their employees partners. So another thing to think about is how optimizing your business investment toward longer-term growth businesses can help. Ecolab is a company that has developed chemicals for cleaning laundry and dishes and sensors to adjust water use in cleaning machines like dishwashers and washing machines for the hospitality industry. These work to reduce the energy and water needs of their customers. Their technology has helped their customers save 190 billion gallons of water, which is equivalent to the drinking needs of 675 million people just in 2022. So all of these things lead to higher profitability, and in the case of publicly traded companies, better stock performance. So there's a growing body of empirical research evidence also pointing to this. In 2020, Accenture did a study that found that a high correlation between superior EBITDA margins, return on invested capital, and stock price appreciation for companies scoring higher on ESG metrics. The MSCI KLD Socially Responsible Index has outperformed its peer S&P 500 index over 30 years. As an investment professional, I can tell you that is an amazing feat. And there are several meta-studies showing that there is equal or better performance with lower risk of companies with a focus on sustainability. So when we're looking for companies in which to invest, we begin by looking for these companies that have a competitive advantage or a moat to determine and demonstrate that they're solving a need of society. Then we look at their ability to be profitable over the long term, generate a return on invested capital, which is a measure of what they were able to do with the planet's and society's resources that they used as inputs for their businesses, because we wouldn't want them to be squandering these resources. And finally, we consider how the fruits of those inputs are distributed to the company's customers, employees, executives, shareholders, and society at large. And this is really our sustainability lens. So now that I've talked a little bit about why this all matters, I'm going to talk about some of Tom's questions about how we do this. Things like what should a company measure, what should they report, and what should be a priority. So I'm going to do this through the lens of Riverwater's sustainability practice. We have a 3-pillar process. The first one is due diligence, which helps us understand a company's current attention to these sustainability or ESG factors. In addition to having dialogue with the companies, we read all publicly published reports, things like sustainability reports, annual reports, corporate websites, all of that information. These documents really tell the story, so it's important to have it be told well. Additionally, this is an important place, a way for management to understand where they are now, because you really can't improve on what you're not already measuring. So reporting is very important. Who's reporting? Well, today, basically all large companies report on ESG. 92% of S&P 500 companies have formal sustainability reporting, and smaller companies are getting on board rapidly. About 60% of the next 500 largest companies have formal sustainability reporting, and that's up from 40% just 2 years ago. In terms of what should be reported, we always tell companies to begin where you are. You just need to tell the story of where you are. And don't let the worry about perfection get in the way of your getting started. Start where you are, and then work to improve, because your peers are doing that. And today, stating intention regarding sustainability topics isn't really enough. You're a little behind if that's where you are, but start where you are. Measurement and goal setting are becoming very mainstream, and demonstrating progress toward achieving goals is the gold standard, and many companies are already there. We always suggest to use widely accepted reporting standards like the science-based targets and TCFD for greenhouse gas emissions, the UN Guiding Principles on Human Rights for Human Rights Disclosure, CDP and the Water Aqueduct Tool for water stewardship, and the Value Reporting Initiative, which is formerly SASB, and the GRI for general reporting. Using these tools will ensure that you're measuring what stakeholders really care about. And because these tools are generally aligned with each other and with some proposed legislation, like what Hillary was talking about, the SEC's greenhouse gas reporting requirement is aligned with the TCFD reporting structure. Using these tools can help reduce reporting fatigue, which is a very real thing. And so standards help everyone. And interestingly, using this detailed reporting that includes measurement, goal setting, and progress can help protect you against 2 unfortunate trends in our industry. The first is greenwashing, which is making an unsubstantiated claim to deceive consumers into believing that a company or its products are environmentally friendly or have a greater positive social or environmental impact than is true. Truly, the best way to guard against greenwashing is to report detail on your efforts. The second trend is something called green hushing, which is quite new. And this is where companies are starting to say too little about their sustainability commitments and achievements, because the threat of being labeled a greenwasher has become so worrisome that many companies lay low when it comes to sustainability communications. Our advice is for companies to truly embed meaningful sustainability into their business, report truthfully on what they're doing, and strive to do better on both actions and reporting. So that's where we start with reporting. So our second pillar, which is probably the most important, is our engagement practice, where we work with companies to improve on their sustainability practices. And for this, it's really important to know where to focus your efforts. And we always suggest that companies begin with a materiality assessment. And that's where you poll your stakeholders and ask them to chime in on what ESG factors have the greatest potential to affect the business, and also which factors does the business have the greatest potential to impact. And then you plot them. I'm going to do my drawing up here. On the x-axis, you plot the greatest impact to business. On the y-axis, it's the greatest impact to stakeholders. And so what you hope for is that these topics form an up and to the right line, and then you want to focus on the ones in the top right quadrant. So let me use a simple example. If we were to poll 2 companies about 3 ESG topics, one being water stewardship, the second being data security, which is a product safety feature, so it's a social factor, and the third being executive pay tied to long-term performance metrics. If you were to ask a beverage maker to rank those, chances are pretty good that the water stewardship is going to come in top right, because for them, a clean and reliable source of water is paramount to their success. Without it, they can't produce their product. And if they negatively impact the river basin where they're taking water and the community is upset, they're probably not going to be able to expand their facility in the future. On the other hand, if you asked a financial services company to rank these 3 topics, data security and privacy would be up and to the right, because that's paramount to their business being successful and to the safety of their customers. So it's very important that companies don't look at sustainability as a box-checking exercise where you're just trying to check all 32 boxes from whatever person or entity is asking you. It's really important that you focus on those that are most salient to your business and your stakeholders. So let me talk about our third pillar, which is what we call collaboration with ESG thought leaders. And the reason this is important to us, and I think to anybody looking at sustainability, is because the world is ever changing. And the social and environmental factors that companies must care about are changing as well. And so we partner with the likes of some organizations Tom has mentioned, CDP, Ceres, the Water Council, the Investor Alliance for Human Rights, Wisconsin Sustainability Council. And by the way, I failed to mention before that they can help you with your materiality assessment. So we partner with them to become educated on what are the salient ESG topics for companies to be thinking about. And then sometimes we partner with them to help our companies move forward. And I want to talk a little bit about water stewardship. Water, as everybody here knows, is really a priceless resource, which has traditionally been treated as a free resource with little attention given to its source, scarcity, or quality, all of which have the potential to negatively impact a business that relies on water. In fact, 70% of the world's fresh water is used in agriculture, making it extremely important that food and beverage companies have sound policy and practice for water stewardship. It's not enough for an individual food or beverage company to pay attention to its own water stewardship. If the other users of a given source of water are not good stewards, they're all going to be impacted. The current situation in the Colorado River Basin really speaks to this. You've all been reading about it. So we have engaged with 3 of our portfolio companies that are food and beverage producers, a lemon company, a non-caloric soda company, and